We're going to talk about the first full week of September, starting off with a little bit of a relief rally in risk assets that we saw after sort of a horrible close to the end of August.
We'll look at equity prices. So the last week, some green on the board. You'll notice the numbers for the week are generally larger than the month-to-date numbers. And basically what happened is after Jackson Hole, when Jerome Powell spoke, that was the end of August. We had 7 consecutive down days for U.S. equities on the S&P 500. Markets got oversold on a technical basis. And so then last week, we finished off the week with 3 very strong up days, a bit of a relief rally from those oversold conditions. So you got some strong returns across U.S. equities, pretty much flat for foreign equities, though.
Yeah. And then in the fixed income markets, we saw risk assets do well here.
Yeah. The green at the bottom of the page, high yield bonds, emerging market bonds, generally perform well when equity markets are rallying. The red for the rest of the fixed income asset classes caused by some rising treasury yields. Central bank news last week, it was the European Central Bank's turn and the Bank of Canada's turn to do large rate increases. So the ECB doing their largest policy rate increase ever of 0.75%, and Bank of Canada following similarly with a 0.75% rate increase.
Giving Jerome Powell the runway to probably do 75 next week, right?
Yep.
Alts, in the alt space, another up week.
Yep, and global REITs rallying right alongside equities. In the commodity space, flat. You're seeing some negative returns in the energy space. That was actually just natural gas prices coming off of their rampant pace of gains that they had experienced. So some negative returns in the energy space, and then agriculture. So looking at grain, softs, livestock, all positive, continuing to have impacts on inflation.
Yeah, and we'll talk a little bit about where the inflation print comes out tomorrow, and we'll see how that's going to be trending. But we'll move on to look at the labor market, because there's a lot of hope, I'll call it, being put into the labor market of holding the economy up. We've got some interesting data here on the difference between the household survey and the labor report. So maybe we can go into detail and tell us what this graph is showing us.
Yeah, trying to look under the hood and parse out the momentum that we're seeing in the labor market, because that has been the strongest performing area of the economy. And what everybody's familiar with is the monthly non-farm payrolls report that comes from something called the Establishment Survey, that basically surveys companies and they say, hey, who's on your payroll? And that's the, we got 300,000 jobs added last month, 500,000 before that. That's the Establishment Survey. So that dark blue line, that's the 6-month change in total employment as measured by the Establishment Survey. That's still performing very well, continuing to see jobs growth. Evidence that we are currently not in a recession. But we want to compare that to a couple things. One is the household survey, and that's the light blue line. So that's a broader measure of employment, and that's taken by actually calling up households and saying, do you have a job? Yes or no? So different survey methodology, broader representation of employment. You can see that has really slowed, grinded almost to a halt. Over the last 6 months, very few jobs have been added within the household survey. And so that points to perhaps a shift in momentum in the labor market. And we can talk about the differences between these two things as well. And then the last thing that shows a shift in momentum, a downshift in momentum, is by looking at revisions to the non-farm payrolls report, revisions to that Establishment Survey. We know the Establishment Survey is a very bad leading indicator of economic activity because it is subject to plenty of revisions, especially around economic turning points. And what you saw as we were getting out of COVID, the gray bars, which measure the 6-month total revisions, they were coming in extremely hot. We're talking about, 1.6 million jobs revised into the establishment report when the labor market was really on fire in 2021. And you notice that's shifted now. We've had 4 consecutive months of downward revisions to the non-farm payrolls report. And so, another measure of just showing the momentum has slowed here quite dramatically.
And these are significant changes, right? And so what leads to this sort of divergence and noise in the establishment?
Yeah. So the two primary reasons why you get a big divergence first between the household and the establishment survey is from job changing. So if you change your job, during the reference period, it's quite possible that you can get included on 2 payroll reports in the same month. So you get counted twice. We know people have been changing jobs a lot. So that can artificially inflate the establishment survey and lead to subsequent revisions. And the other part is births and deaths of companies. So bankruptcies and then starting new companies. Those have a lag before they get put into the establishment survey. If a company goes under, they may not submit payrolls in the establishment survey. They don't get excluded from the sample. Or I'm sorry, it doesn't show job losses in the sample. They stay in the sample. Versus the household survey, if your company just went under and you got laid off and they call you, you say, hey, I lost my job. So we think that explains a big part of the divergence here is we've probably shifted from company births to deaths and then also job changing. And so that's the big divergence there. And you can see the establishment survey is trying to catch up, or catch down rather, to the household survey through the revision process. That's basically what's happening.
So there's a leading indicator. It's not saying things are awful yet,
right?
But it is saying the momentum is coming out of the market.
If you're subscribing to the soft landing narrative, this probably has a little bit of that for you. The labor market's still strong, but coming off the boil.
So the Fed sees this and says, I could still raise interest rates into this because the market's strong enough to handle it.
Yep.
Okay. So let's turn to inflation. As we said just a minute ago, we're going to get the print tomorrow. Our forecasts show that probably headline's going to come down.
Yep.
But core not so much.
Yep. That's exactly right. Headline for August, month over month, is expected to be about flat because of that negative impact or downward pressure coming from falling energy prices, gas prices, et cetera, that the economy has experienced since June. So that should make headline coming about flat. But the alarming thing for the Fed is that core is probably going to move up. So that's the dark blue line that then gets colorful in the forecast area. I'm sorry, the green line that gets colorful in the forecast area. You can see we actually expect that to move back up to about 6.5% year over year over the next few months. And then from there, that's where we sort of segment our forecast horizon, where we look at what the year over year is going to look like, and then the last month, if you were to annualize it, what that would look like. And it's basically going to show through the end of the year, it's going to look like the Fed has made almost no progress on core inflation, which is going to be extremely frustrating for the Fed because they're experiencing the negative consequences of this rapid change in policy and this rise in the Fed funds rate that they've been doing in terms of slower economic growth, but haven't really seen any of the positive impact in terms of bringing inflation down. This is going to be very frustrating, probably a lot more hawkish language. We believe they're going to probably fully deliver on expectations for Fed funds rate increases through the spring.
And so you said they'll feel like it, but let's take the consumer's view of it. How will the consumer feel about the reduction in the headline versus the sort of no reduction in core?
Yeah, the consumer will react to headline more than core. Generally, when consumers create their inflation expectations, they're based off of headline. Because food and energy, although they're volatile and they should be stripped out and they're difficult to predict, that's a lot of what people witness in terms of price changes most frequently. Eventually, they'll notice more and more, wow, I'm paying a lot more if I'm renting my apartment or renting a home. And then the last thing is healthcare costs, medical costs. Those are starting to flow through into core. So they're going to experience that.
Okay. Let's move on to sort of an interesting chart about how the Fed can sort of navigate this landing here, whether it's going to be a soft landing or hard landing, and looking back at historical data as to what they're projecting today versus we don't see anything like this ever occurring in history.
Yeah, basically what the Fed is saying they're going to do is they're going to, through interest rate hikes and reducing the size of their balance sheet, lower core inflation by about 4%. It's going to peak out at about 6.5%. we believe, as we get towards the end of the year, and they want to bring it down something in the 2s. So they're probably going to want to increase it by 4. And they're saying while they're doing that, they're only going to experience a 0.6% increase in the unemployment rate. So this is a classic Phillips curve relationship. And when you run this projection through, history of inflation and unemployment data going back to the 50s, it's an extremely optimistic projection. If the Fed wants to bring inflation down that much, odds are you're going to see an increase in the unemployment rate of 2% or more. And that far exceeds the threshold that typically tips the U.S. economy into a recession, which is usually about a 0.5% increase in the unemployment rate will do it. That's enough to do it. So it'll be very interesting. Next week at the Fed meeting, they publish new economic projections. Do they come to a more reasonable conclusion? That maybe the unemployment rate is going to rise 1% or something like that. Something more in the ballpark of historical reality.
So you mentioned the Phillips curve, so you're going to have to explain that for the viewers. Because some people have said the Phillips curve is dead as a useful measurement. Why do we mention it?
Yeah, the Phillips curve is just a relationship between, for any given decrease in inflation, how much do I expect unemployment to increase, or vice versa. It's just that relationship. And a tremendous number of academic papers have been written about the Phillips curve doesn't exist, is it's dead, what is the slope of it, etc. You ultimately don't know until after the fact. The economy is way different. The Fed is trying to sort of change the narrative, talk less about the Phillips curve, and you'll probably be hearing more and more in the news now, the Beveridge curve, which is the trade-off between how much can I reduce job openings and create an increase in unemployment. And so they're trying to sort of shift the narrative towards that because there are a tremendous number of job openings, right? So hopefully they can reduce job openings without a large increase in unemployment. And that will hopefully reduce inflation.
Yeah. Fingers crossed.
Yep.
Liquidity. So we've entered into the first full month here of balance sheet runoff at the prescribed level.
Yep.
Haven't seen anything happen so far.
Yep. So yeah, the Fed now is expecting to reduce the size of their balance sheet by a maximum of $95 billion per month. And so that started on September 1st. And, that combined with the fact that since Jackson Hole, market expectations for the Fed funds rate, the path of the Fed funds rate have increased quite a bit. Before we were expecting it to peak somewhere around 3.5% early next year, and now it's more like 4% in April of next year is the peak. And all that's really happened here is it's absolutely cemented the low and falling liquidity environment. So we had talked for quite some time that we were going to see the most rapid slowdown in money supply growth we've ever seen. And now it looks like it's just going to stay down there. So the rebound, the pivot, the recovery and liquidity that we're so used to whenever markets sell off or the economy runs into a tough spot. If the Fed raises rates that much and keeps them there for longer, as they're saying they're going to do, you're just going to stay down here for a really long time, which is the worst environment for equities, particularly growth stocks, a low and falling liquidity environment.
And how does this translate into the forecast we're looking at now for GDP growth for Q4 or for Q3?
Yep. Yeah, how is Q3 trending? Well, this is what we talk about, the negative side effects of the monetary policy that the Fed is currently implementing. I haven't seen the positive side effects yet in terms of bringing inflation down, but definitely seeing the negative side effects. We had 2 negative quarters of real GDP growth the first half of the year. Q3 is trending at about 1.3%. Seasonally adjusted annualized rate is the expectation now. And you can see the parts of the economy that are most sensitive to rapid changes in monetary policy, like, for example, the housing market. That's the orange bars. That has been the number one offender of data coming in worse than expected. Housing starts, realtor commissions. The housing market has absolutely frozen since mortgage rates shot up close to 6%. And it just keeps detracting from economic growth.
And we've seen just start this beginning of a tail off in consumer spending.
Yep, consumer spending every quarter this year it started out and said, hey, this is going to be a big contributor because we know consumers have savings and their balance sheets are strong and so on and so forth. By the time we get to the end of the quarter and everything's tallied up, they are contributing far less to GDP growth than we expected at the beginning of the quarter. And that's because of the impact of inflation. It's been stubbornly high, not coming down. And, that's in real terms, consumption is not expanding.
Right. So we're looking at 1.3% with a margin of error of 1.3%.
1.3%.
So we could have 0 or 2.6 basically as we sit here today.
Yep.
Okay. And then finally, the recession indicator, not much of a change, but slight movement.
Yeah, still elevated. You see the probability that we're in recession right now still very low, and the best sort of coincident or very short-term indicators for recession are labor market variables. So the fact that we continue to get hundreds of thousands of jobs added on the non-farm payrolls report, it basically confirms we are not in a ember recession right now.
Right.
Does not mean that over the next 12 months that we won't be in a recession. So that's where we see probability closer to 50%, which is off of the highs from the year, thankfully, but still elevated to the point that want to be more conservative in terms of portfolio positioning. It's an attractive environment for high quality bonds, for example, not very attractive for equities.
Yeah. And we've been continuing to make that transition from equities to high quality bonds, shorter on the curve for our clients over the last almost the whole year here. So,
yep.
All right, great. Let's wrap it up there and see if we have some questions in the queue, which I do believe we have. Are home buyers still competing with corporate real estate investors given the rise in interest rates? Yes, they are.
Yeah. So it's very interesting market by market, because there definitely is less competition now than there was early in the year because there's just fewer buying and selling activity. A lot of people have been priced out of selling their home because if they sell it, they need to go buy a new home and mortgage rates are 6% and their current mortgage is 3%. So why would I do that?
Yeah.
Right. Yeah. So there's definitely less competition. And then we're also starting to see some institutional residential REITs completely exiting certain markets. Mm-hmm. So, there was a REIT that announced a few weeks ago that they're totally exiting a lot of areas in the Sun Belt, like Memphis, Tennessee was one example, because the price environment and the cost of financing and the cost of labor to flip these homes to be rented out, it just doesn't make sense anymore.
Yeah.
So
what happens in that instance when someone like exits the business? What happens to their property, their inventory, all of that stuff?
Yeah. Yeah, the existing inventory, they usually say, all right, we have what we need here. We're going to continue to seek to rent it out. Mm-hmm. If they've really overdone it, like Zillow did, last year, then it's more of a fire sale type situation. Like, I just need to offload this inventory into a strong housing market. But, most of the time it's, hey, if you go a month from now and you go to buy a home in this area, you're probably not competing with that institutional buyer anymore, and it might actually be easy for you to buy a house.
Yeah, get some better prices.
Yeah.
All right, next question. Stock market crash feels like a term that is overused. How do you define a crash? What's the technical definition of a crash?
Yeah. Well, there is no. That's the point of the question. There is no agreed upon official definition of a crash, but generally speaking, if you look at the order board and you see bids and asks, and you see a whole lot of asks and no bids, there aren't buyers and sellers matching in the market. You just have everybody trying to sell with nobody buying, and prices just go straight down. That's a crash, when one side of the order board basically dries up. Mm-hmm. And we have switches, we have things, risk mitigation tools in equity markets now that basically mean you're not going to get crashes like you used to.
Right.
Like even during COVID, some people forget in March 2020, there were days where the market would be open from 8:30 to 8:40. And then it would be closed for 15 minutes because we were down 15%.
Yeah, people forget that, yeah.
So that was the closest thing to a crash.
Yeah.
But yeah, very overused term.
Yes, very much so. And if you think, like a lot of people say 20% margin is where you think about you enter into a bear market, like what are some of the other indicators that people might relate to? corrections, crashes,
Yeah.
stuff
Yeah.
like that.
Yeah, dips, corrections. That people can generally agree on the way down. You know, a dip is 5%. You take whatever equity index you want, like the S&P. Correction is 10% from the high. But then is it intraday or is it the closing high? You know, you get into that. And then bear market is 20%. But then if you were down 20 and now you're only down 16, are you out of a bear market?
Right. Yeah.
Some people would say absolutely not. Not until I'm down less than zero. I have gains. I need to get all the way out of this. Some people would say, yeah. Some people would say, no, if I'm down less than 20, I'm not in a bear market anymore.
Yeah,
So,
I'm not sure why people need to put a label on it, but there is some psychology to how people react to those terms. So it's a good question. All right, we got any other questions here? How do you see the Russia-Ukraine war playing out in markets? What's the latest? It's been relatively quiet in the news because there's a lot of other things going on, but there's been a lot happening under the surface.
Yep. It's very difficult to predict how it's going to end. I mean, Ukraine is actually potentially taking back some territory now, which is, that's new information. Anybody who tried to predict this has been wrong, basically. But in terms of how it impacts markets, this is obviously a humanitarian crisis and, a serious problem that is not something that doesn't bode well for the future of geopolitical relationships, et cetera, et cetera. But in terms of if you're trying to predict asset class returns, this is not the signal, this is noise. If there is signal in it, it will come through to the things that matter, which are liquidity, inflation, economic growth, and recession.
Yeah.
And the primary channel through which this situation, this conflict has led to signal has been through inflation. And so that'll be something we'll continue to monitor because that is sort of the clearest thing as to how this situation is going to impact markets.
Maybe another related question. How long can Russia continue to have their economy in this position, given everything that's going on? If you're not sure, but it seems like at some point they're going to have to change strategies.
Well, Russia is selling all of the oil and gas they produce still. And their current account is in a massive surplus. So financially, they actually can continue to do this for a very, very long time. I know when this conflict initially started, the idea was nobody's going to buy anything from Russia and it's going to send their economy into a deep depression like we've never seen before. But that lasted for maybe 3 weeks. And now the commodities that Russia exports are in such high demand globally that through one channel or another, they're effectively selling absolutely everything they're producing and making massive profits. So how long can Russia continue this strategy? Based on their current account and other financial measures, as long as people continue to buy their oil and gas. And as we think about energy security or lack thereof globally, it seems like that's going to be a long time.
All right. Any other questions in the queue here? I don't think so. All right, so we'll wrap it up there. Thanks for joining us, and we'll be back next week.